Just a few hours ago, the eyes of the global capital market were fixed on Beijing. Today is the 10th of December 2025. Kristalina Georgieva, Managing Director of the International Monetary Fund, IMF, has just concluded the annual Article IV consultation on China. I watched the entire press conference. This is the first in-depth review of the world's second-largest economy by the IMF since August 2024. Right now, Wall Street analysts are still fussing over trivialities in China, use trade, and media headlines are filled with the cliché phase of uncertainty and escalating risks. But what I see is a quietly changing map of global capital flows. For decades, Warren Buffett and I have firmly believed that the essence of investment lies in value judgment, and public panic is often the best entry signal. Today, the market is repeating the same mistake that has occurred countless times in history, replacing rationality with emotions, and negating long-term value with short-term volatility. This freshly released IMF report is by no means an ordinary stack of documents. It is a clear signal, one that will completely reshape international capital's confidence in Asia and emerging markets, and may even indirectly restructure the economic landscapes of Japan and the world at large. My optimism about China is not a passing fancy. As early as 2008, I strongly recommended Warren to invest in BYD. Back then, no one believed that a Chinese automaker could gain a firm foothold in the global market. But facts have proven that we acquired more competitive assets at a lower cost. Today, such an opportunity has emerged once again. The IMF has raised its 2025 and 2026 economic growth forecasts for China to 5.0% and 4.5% respectively. Behind this upward revision are a series of welcome macroeconomic stimulus measures rolled out by the Chinese government, expansionary fiscal policies, monetary easing, targeted measures to boost consumption and the real estate sector, as well as the alleviation of fiscal pressures brought about by local government debt swaps. While everyone else is looking for reasons to panic, I see the resilience of structural transformation, the emergence of intrinsic value, and the dawn of capital repricing. This report is the starting gun I have been waiting for. It will ignite those assets that have been unjustly battered by the market's fear-driven sentiment. I have always believed that every dollar invested in China has a comparative advantage. High-quality companies here are stronger than their competitors, yet come with lower price tags. If you are still being swept up by market noise, if you are still hesitating on the sidelines, this may be a rare window of opportunity to tap into a value depression in your lifetime. Today, from the perspective of a value investor, I will conduct an in-depth dissection of this report, revealing why those severely undervalued Chinese assets are brewing an unstoppable wave of valuation recovery amid this macroeconomic transformation. First and foremost, I must reiterate an investment truth that has been proven time and again: mean reversion. There is no market that rises forever, nor one that falls perpetually. Just as a pendulum always swings between extreme optimism and extreme pessimism, the valuation of the capital market will eventually revert to its intrinsic value. This is not metaphysics. It is an inevitable outcome of the combined forces of human nature and economic laws. The equity risk premium of China's stock market has now reached an unreasonable level. Let us let the data speak, for data is the cornerstone of value investing. As of the end of November 2025, the price-to-earnings FAE ratio of the Hang Seng Index stood at a mere 11.89 times, while that of the S&P 500 index soared to 27.4 times. The former is less than half of the latter. In terms of price-to-book PFB ratio, the S&P 500 hit 5.46 times, placing it above the 90th percentile since 2010, whereas the PFB ratios of the CSI 300 and Hang Seng Index still linger at historically low levels. Even more noteworthy is the gap in dividend yields. The average dividend yield of the S&P 500 is around 2%, while the dividend yields of core assets under China's special valuation for central enterprises, special valuation, generally range from 6 to 8%, with some banks and energy companies even exceeding 10%. What does this mean? It means that by buying these assets now, you can earn cash flow returns far exceeding those of high-quality U.S. assets solely through dividends, while their stock prices themselves remain in a state of severe undervaluation. Throughout Warren's and my investment careers, our most successful cases have often been born in times of extreme market pessimism. During the stagflation period in the United States in the 1970s, the market was in a slump. Yet those enterprises that maintained consistent dividends and stable cash flows ultimately rewarded us handsomely. Today's Chinese market is staging a similar scenario. Risks are being infinitely magnified, and value is being ruthlessly ignored. And the most crucial signal in the IMF report is that China's policies are shifting toward shareholder returns and consumption stimulation, precisely the two core logics that the capital market welcomes most. The Chinese government is stabilizing the economic fundamentals through measures such as raising the retirement age, advancing local government debt restructuring, and optimizing the fiscal framework. At the same time, it is boosting consumption through expansionary policies. All these initiatives will directly enhance corporate profitability and lift shareholder returns. When policy dividends collide with extremely low valuations, the force of mean reversion will become unstoppable. If mean reversion is the driving force behind valuation recovery, then structural transformation is the core of long-term value growth. The four key phrases repeatedly mentioned in this IMF report, green transition, digital economy, elderly care industry, and supply chain resilience, are by no means empty slogans. They are a clear blueprint for the transformation of China's economic structure. I must emphasize that this is not a simple economic rebound, but a profound industrial iteration. The real estate sector, a representative of the old economy, is undergoing consolidation, and those inefficient, highly leveraged enterprises will be eliminated by the market, while the engines of the new economy are revving up at an accelerated pace. This transformation is like the metabolism of a forest. Only when old trees fall can sunlight and soil be freed up for new vegetation to thrive. The investment opportunities we are going to explore today are precisely the leaders of the new economy and the survivors of the old economy. They either conform to the trend of industrial upgrading or have consolidated their positions amid industry adjustments by virtue of their strong economic moats. Let us break down the investment logic behind each of these key phrases one by one. Green transition. The IMF explicitly points out that the global green transition cannot be achieved without China's supply chain. This means that in sectors such as electric vehicles, lithium batteries, and photovoltaic PV energy, the cost advantages and technological barriers already established by Chinese enterprises will be converted into long-term competitive edges. The logic behind my investment in BYD has never changed. In a trend with high certainty, enterprises that possess core technologies and scale effects will ultimately reap excess returns. Digital economy. The report identifies it as the key to improving China's productivity. After several years of regulatory rectification, China's internet technology enterprises have transformed from growth stocks that pursued scale expansion at all costs into value stocks with abundant cash flows and stable profitability. They no longer burn money blindly. Instead, they have begun to focus on core businesses and launch large-scale share repurchase programs. This is highly aligned with the shareholder return philosophy that we have long advocated. Elderly care industry. Population aging is not a challenge unique to China, but China's enormous elderly population base is spawning a massive market driven by rigid demand. From healthcare and elderly care insurance to elderly care services and age-friendly products, the certainty of this track is comparable to the baby boom consumption opportunity in the United States in the last century. The IMF specifically mentions that China needs to reduce the household savings rate through reforms, and improving the elderly care security system is the key to unlocking consumption potential. Supply chain resilience against the backdrop of adjustments in the global trade pattern. China is strengthening the independent controllability of its industrial chains. This not only means the upgrading of high-end manufacturing, but also implies that enterprises with a say in key materials and core components will receive dual support from both policies and the market. These key phrases collectively point to one conclusion: China's economy is shifting from investment-driven growth to consumption and innovation-driven growth, and from scale expansion to quality improvement. The Special Action Plan for Boosting Consumption, jointly issued by the General Office of the Communist Party of China, Central Committee, and the General Office of the State Council, has clearly stated that efforts will be made to expand investment in consumption infrastructure and support the construction of projects in fields such as education, medical care, elderly care, and child care. This is in line with the policy recommendations of the IMF and provides a clear investment direction for the capital market. As value investors, we must learn to see through the surface to grasp the essence. Short-term market volatility is always filled with noise, but the signals of industrial trends and intrinsic value are crystal clear. The current valuation of Chinese assets not only reflects short-term market panic, but also underestimates the long-term dividends of structural transformation. This is precisely the core of contrarian investing: discovering value where the public overlooks it, and adhering to rationality when emotions run to extremes. Next, I will elaborate on 5 categories of severely undervalued Chinese stocks in detail. They are either direct beneficiaries of mean reversion or core drivers of structural transformation. More importantly, they all meet the investment principles that I have adhered to throughout my life: strong economic moats, stable cash flows, sustainable profitability, and a sufficient margin of safety. Warren and I have spent our entire lives searching for effortless money-making assets, not shortcuts based on speculation, but cash cows that possess stable cash flows, strong moats, and consistently distribute dividends to shareholders. Today, the core assets under China's OE special valuation are exactly such treasures that have been seriously misunderstood by the market. The IMF report repeatedly emphasizes fiscal sustainability, and behind this lies a key logic: China's state-owned enterprises, especially those core assets related to national economic lifelines and people's livelihoods, must increase dividend payouts to supplement fiscal revenue. This is not my speculation, but an inevitable outcome of policy orientation. As local government debt restructuring enters a deeper phase, dividend payments from high-quality SOEs have become the most stable source of fiscal supplementation. This means that the dividend payout ratios of these enterprises will not only remain at a high level, but may also continue to rise. The characteristics of these assets could not be clearer: banks, energy companies, and telecom operators. They may not be sexy and lack the explosive growth stories of tech stocks, but they possess monopolistic positions that ordinary people can hardly imagine. China's large-scale banks serve the largest number of corporate and individual customers in the world, and their non-performing loan ratios have remained stable for consecutive years. Energy enterprises hold the lifeline of the country's energy supply and possess pricing power, Amid global energy price fluctuations, telecom operators have built the world's most extensive communication networks with almost irreplaceable user stickiness. Let us measure them with the yardstick of value investing. Currently, the P/E ratios of these enterprises generally range from 4 to 5 times, and their P/B ratios are less than 0.6 times, while their dividend yields are as high as 6 to 8%, with some leading enterprises even exceeding 10%. For comparison, the P/E ratio of Bank of America is around 12 times, with a dividend yield of only 3%. ExxonMobil has a P/E ratio of 8 times and a dividend yield of 4%. It is hard to imagine that in the world's major economies, one can still find such high-quality assets that are ridiculously cheap. I often say, investment should seek opportunities with a margin of safety. In the current interest rate cut cycle, these high-dividend SOE special valuation assets are essentially bonds with growth attributes. As central banks around the world cut interest rates and bond yields continue to decline, assets that can provide a stable 6 to 8% dividend yield while achieving profit growth along with economic recovery will have irreplaceable appeal. The market dismisses them as baggage of the old economy, but in my eyes, they are money, printing machines that can weather economic cycles. The logic behind Warren's and my investments in American Express and Coca-Cola is essentially the same. We do not pursue short-term stock price surges, but instead enjoy long-term stable cash flow returns. These Chinese OEs are like U.S. utility stocks in the 1980s, undervalued by the market simply because they lack imagination. But the true essence of value investing is precisely to discover certainty where others overlook it. Remember, when a company's dividend yield far exceeds the bond yield, and it has stable profits and consistent dividend payouts, its undervaluation by the market cannot last. These core SOE special valuation assets are proving their value through real dividend payments, and the IMF report is the catalyst that will make the market reevaluate them. If SO special valuation assets are defensive treasures, then China's manufacturers of the new 3 exports electric vehicles, lithium batteries, and photovoltaic products are global champions with both defensive and offensive attributes. Chinese enterprises in these sectors have established an unshakable monopolistic position in the global market. The IMF report states unequivocally, the global green transition cannot be achieved without China's supply chain. This is not a compliment, but a fact. In the global electric vehicle market, Chinese enterprises already account for over 60% of the share. In the lithium battery sector, 7 out of the world's top 10 manufacturers are from China, with a combined market share exceeding 80%. And in photovoltaic modules, the global share is as high as 90%. This monopoly is not built on policy protection, but on solid cost advantages and the speed of technological iteration. When I invested in BYD, some people questioned that Chinese automakers cannot build good cars, but today BYD's global sales have surpassed Tesla, making it the world's top-selling electric vehicle brand. Behind this achievement is its all-round leadership in battery technology, vehicle manufacturing, and supply chain management. BYD's Blade battery offers higher energy density, stronger safety performance, and is 15 to 20% cheaper than competitors' products. Its vertically integrated supply chain can minimize the impact of raw material price fluctuations. This cost advantage has formed an insurmountable economic moat. Of course, the market will always be disturbed by geopolitical noise, tariffs, technological restrictions, trade barriers, all of which are short-term disruptions. But I have always believed that great enterprises can overcome all obstacles. In the 1980s, Japanese automakers faced tariff barriers in the United States, but they ultimately captured the U.S. market by virtue of their cost, effectiveness, and technological advantages. Today, China's manufacturers of the new three exports are repeating this piece of history. Here is a counterintuitive investment logic compared to vehicle and equipment manufacturers. Upstream core material and equipment suppliers are more worthy of attention. For example, enterprises producing cathode materials, separators, and electrolytes for lithium batteries, as well as manufacturers of silicon wafers and inverters for photovoltaic systems. They not only benefit from the growth of downstream demand, but also possess higher gross profit margins and stronger bargaining power when downstream enterprises see their stock prices decline due to trade war fears. These upstream core suppliers are often unduly punished, which is precisely the entry opportunity for value investors. The data does not lie. Chinese enterprises hold a global market share of over 70% in core lithium battery materials and over 80% in photovoltaic inverters. The pace of technological iteration of these enterprises far outpaces their peers. The conversion efficiency of photovoltaic cells improves every 18 months, and the energy density of lithium batteries increases by more than 10% annually. This dual advantage of technology plus costs makes them almost unrivaled in global competition. I never invest in enterprises that tell stories, but I will not hesitate to invest in those that get things done. China's manufacturers of the new three exports have proven their strength through their global market share, and the current low valuations caused by trade war panic are exactly a gift for value investors. Remember, the impact of geopolitics is short-term, while the power of industrial trends is long-term. In the past few years, China's internet technology enterprises have undergone a rigorous regulatory rectification, which has made many investors shy away. But in my view, this regulatory overhaul is not destruction, but reshaping. It has transformed these enterprises from growth stocks that expanded blindly into value stocks that focus on core businesses and prioritize shareholder returns. This is precisely the ideal target for value investing. The IMF report clearly points out that the digital economy is the key to improving China's productivity. This means that the purpose of regulation is not to suppress internet enterprises, but to enable them to better serve the real economy within a compliant framework. Today, regulatory policies have stabilized and the uncertainty that the market was most worried about has been eliminated. The value of these enterprises is now being repriced. Let us take a look at the current situation of these enterprises. After several years of adjustments, giants like Alibaba, Tencent, and JD.com have divested non-core businesses and focused on their main operations, such as e-commerce, social networking, and cloud computing. Their cash flow positions are healthier than ever. Alibaba's cash and cash equivalents exceed RMB 300 billion, and Tencent's free cash flow has remained above RMB 100 billion for 3 consecutive years. More importantly, they have started large-scale share repurchases and dividend increases, which is highly consistent with the shareholder return philosophy that we have long advocated. A comparison of the valuations of Chinese and U.S. tech stocks reveals a massive value depression. As of November 2025, Alibaba's P/E ratio is only 10 times, and Tencent's is 12 times, while Amazon's is 35 times and Meta's is 28 times. In terms of P/B ratio, both Alibaba and Tencent have ratios below 2 times, whereas Amazon and Meta are above 8 times. Even more noteworthy is that Alibaba and Tencent's dividend yields have reached 4 to 5%, while those of Amazon and Meta are less than 1%. What does this mean? You can now acquire assets with profitability comparable to U.S. tech giants and more stable cash flows at less than 1/3 of the price. This valuation gap is not due to the lack of competitiveness of Chinese tech enterprises, but a result of unjustified sell-offs driven by market panic. When Warren and I invested in Apple, we also experienced a period of market panic toward tech stocks. But the logic we adhered to never changed. The value of an enterprise depends on the present value of the free cash flows it will generate in the future. China's internet tech giants boast the largest user bases in the world. WeChat has over 1.3 billion monthly active users, and Taobao has over 800 million annual active buyers. The user stickiness formed by these platforms constitutes an economic moat comparable to Coca-Cola's brand barrier. More importantly, these enterprises are expanding from the domestic market to the global market. Alibaba Cloud has become the world's third-largest cloud computing service provider. ByteDance's TikTok has over 1 billion users worldwide. The overseas revenue of Tencent's gaming business already accounts for more than 30% of its total revenue. This global expansion is opening up new growth space. The regulatory rectification has come to an end, and these enterprises have shifted from reckless growth to prudent operation. They no longer pursue scale expansion at all costs, but focus on profitability and shareholder returns. In my opinion, this is precisely the best time for value investing. When a high-quality enterprise experiences short-term pains, its valuation is pushed down to a historical low and its long-term competitiveness remains intact. Buying and holding it for the long term will ultimately yield substantial returns. Throughout my life, I have witnessed countless investment trends, but there are very few tracks that can span a decade, have rigid demand, and see their scale expand continuously. China's silver economy is exactly such a nearly perfect investment target. The IMF report dedicates a significant portion to discussing China's aging challenge, but in my view, the flip side of challenge is a certain investment opportunity. Aging is a negative factor for the real estate sector, but it is an epic boon for the pharmaceutical, medical device, and elderly care insurance industries. First, let us look at the most solid fundamental demographic trends. China's population aged 60 and above has exceeded 300 million, accounting for 21% of the total population. By 2035, this proportion will surpass 30%, marking the entry into a stage of severe aging. What does this mean? It means that in the next decade, the demand for health care, elderly care services, and elderly care insurance will grow exponentially. This demand is not optional consumption, but rigid demand. Everyone will grow old, face health issues, and need elderly care security. This is a basic law of human nature and the most solid moat for investment. The IMF report explicitly recommends that China needs to improve the elderly care security system and expand the coverage of long-term care insurance. This resonates with the medical reforms and supportive policies for the elderly care industry that the Chinese government is advancing. With policy support and rigid demand as the backbone, the growth certainty of this track is comparable to the baby boom consumption opportunity in the United States in the last century. So how should we screen investment targets? My criteria are simple. I only focus on two types of enterprises. One, innovative pharmaceutical companies with overseas expansion capabilities. China's generic drug manufacturers have fallen into intense internal competition, but the innovative drug sector is on the rise. In the past few years, R&D investment in China's innovative drugs has grown at an average annual rate of over 20%, and several innovative drugs have successfully obtained approvals from the US FDA and European EMA, making their way overseas. This means that they can not only share in the growth of the domestic market, but also enter the global market to gain higher valuation premiums. Compared with us innovative pharmaceutical companies, the P/E ratios of leading Chinese innovative drug enterprises are only 30 to 40 times, while those of their US counterparts are generally above 60 times. This valuation gap is exactly the opportunity for value investing. Two leading insurance companies with massive insurance float, The core competitiveness of the insurance industry lies in the scale and utilization capacity of insurance float. This is the core logic behind Warren's and my investment in Berkshire Hathaway. China's leading insurance enterprises have accumulated trillions of yuan in insurance float. These funds can generate stable returns through prudent investments. At the same time, as aging intensifies, the demand for life insurance, health insurance, and long-term care insurance will continue to grow, further expanding the scale of insurance float. Currently, the P/E ratios of these insurance enterprises are only 8 to 10 times, and their P/B ratios are 0.8 to 1.2 times. Whereas AIA Group, American International Assurance, has a P/E ratio of around 15 times and a P/B ratio of 2.5 times. The valuation advantage is extreme. I never invest in industries that rely on policy subsidies and have unstable demand. But healthcare and insurance are different. Their demand stems from human nature and the inevitable changes in population structure. No matter how the economy fluctuates, people's demand for health and elderly care will never diminish. This is the most fascinating aspect of this track. It does not experience drastic cyclical fluctuations, but only has a continuous upward growth curve. In my view, this is the most certain investment track in the next decade, bar none. There is a common misconception in the market that Chinese consumption is downgrading, but the truth is that Chinese consumption is undergoing stratification. The growth rate of luxury consumption is slowing down, but daily necessities and cost-effective domestic brands are accelerating their market share capture. The IMF report emphasizes that stimulating consumption is the key to China's economic recovery. And these leading domestic brands that have survived market competition are the biggest beneficiaries of consumption recovery. The logic behind Warren's and my investments in Coca-Cola and See's Candies is equally applicable to China's domestic brands. Great consumer brands are essentially a combination of emotion plus cost effectiveness. China's domestic brands have completed their transformation from imitation to innovation. They understand Chinese consumers' needs better, offer higher cost, effectiveness, and enjoy stronger brand recognition. Take sportswear as an example. The product quality of Li Ning and Anta is already on par with Nike and Adidas, but their prices are only half of the latter's. This is the core reason why they can occupy over 40% of the domestic market share. The industry distribution of these leading domestic brands is very clear: food and beverages, white goods, and sportswear. They share a common characteristic: having survived brutal market competition, only the strong remain. In the consumption downturn cycle of the past few years, a large number of small and medium-sized brands have been eliminated, and market share has become concentrated in the hands of leading enterprises. The CR5 market share of the top 5 brands in the food and beverage industry has increased from 35% in 2019 to 52% in 2025, and the CR5 in the white goods industry has even exceeded 70%. This increase in industry concentration means that leading enterprises have stronger bargaining power, lower cost advantages, and more stable profitability. More importantly, these domestic brands are embarking on a global expansion path. After acquiring the parent company of Arc'teryx, Anta's overseas revenue already accounts for more than 40% of its total revenue. Li Ning has opened multiple stores in Europe and Southeast Asia, with its overseas sales growing at an average annual rate of over 30%. Haier Smart Home's overseas revenue accounts for as high as 55% of its total revenue, making it a truly global brand. This global expansion is opening up new growth space and laying the foundation for the repricing of their valuations. Currently, the valuations of these leading domestic brands are at historically low levels. The P/E ratios of food and beverage enterprises generally range from 20 to 25 times. and those of white goods enterprises are between 10 and 15 times, whereas the P/E ratios of their U.S. counterparts are generally 30 to 40 times. Considering their growth rate and potential for market share expansion, this valuation gap is unreasonable. The IMF report predicts that the contribution rate of Chinese consumption to economic growth will exceed 60% in 2026. With the implementation of consumption-stimulating policies, the profits of these leading domestic brands will grow at an accelerated pace, and valuation recovery is only a matter of time. Remember, the essence of consumption is the will of the people. When consumers of a country begin to identify with local brands, and when these brands possess cost, effectiveness, and innovation capabilities, their rise becomes unstoppable. China's leading domestic brands are repeating the brand rise path of Japan in the 1970s and South Korea in the 1990s. And the current low valuations are the best time to participate in this brand feast. I know that the biggest concern of many investors regarding Chinese assets is geopolitical risks, trade wars, technological restrictions, fluctuations in the international situation. But I want to share an investment philosophy that I have adhered to all my life. Don't let macro concerns overshadow micro excellence. The core of value investing has never been predicting the macroeconomy, but finding undervalued high-quality enterprises and hedging uncertainties through a sufficient margin of safety. The current valuation of Chinese assets has already fully reflected the market's concerns about geopolitical risks, even over-reflected them. When an enterprise has a P/E ratio of only 4 to 5 times and a dividend yield of 6 to 8%, when its global market share exceeds 80%, and when its technological and cost advantages are irreplaceable, the impact of geopolitics becomes a short-term disruption rather than a long-term threat. In the 1980s, U.S., Japan trade frictions intensified, and the market was generally bearish on Japanese assets. However, those Japanese enterprises with global competitiveness, Toyota, Sony, Honda, ultimately rewarded investors handsomely through technological innovation and global layout. Today's Chinese enterprises are facing a similar environment, but they are more competitive, have lower valuations, and enjoy a thicker margin of safety. Throughout Warren's and my investment process, we have always adhered to the worst-case scenario test. If the worst-case scenario happens, can this enterprise survive? Can it maintain its profitability? For the 5 categories of Chinese assets we have discussed today, the answer is a resounding yes. SOE special valuation assets have monopolistic positions and stable cash flows. Manufacturers of the new 3 exports have global supply chain advantages. Tech giants have massive user bases and cash flows. Healthcare and insurance enterprises are supported by rigid demand. Leading domestic brands have cost, effectiveness, and brand recognition. The competitiveness of these enterprises will not disappear due to short-term geopolitical fluctuations. Therefore, the best strategy to cope with geopolitical risks is not to avoid them, but to leave a sufficient margin of safety. When stock prices have already reflected the worst expectations, and when the intrinsic value of an enterprise far exceeds its current market capitalization, the risk is actually minimized. Investment is essentially a game of probabilities. What we need to do is to invest sufficient capital in high-probability events while using a margin of safety to resist low-probability risks. For ordinary investors, I have a very practical suggestion. Don't try to beat the market. Instead, find investment tools that suit you and use a disciplined strategy to cope with volatility. First, regarding the choice between ETFs and individual stocks, if you are not familiar with the rules of the A-share and Hong Kong stock markets and do not have the ability to conduct in-depth research on enterprises, then relevant ETFs may be a better choice. For example, FXI, which tracks the Hang Seng Index, Queb, which tracks Chinese concept stocks, Asher, which tracks the CSI 300 index, and MGI, which tracks Chinese consumption. These ETFs have sufficient liquidity, can diversify individual stock risks, and allow you to gain exposure to China's core assets with one click. If you have a certain level of research ability and are willing to spend time analyzing a company's financial statements, competitiveness, and valuation, then investing in individual stocks can bring higher returns. But remember, individual stock investment requires focusing on leading enterprises. Only choose the top 3 enterprises in the industry. Only select those with moats, stable cash flows, and consistent dividend payouts. Do not be tempted by the short-term surge of small-cap stocks. Whether you choose ETFs or individual stocks, I strongly oppose investing all your capital at once. In the market is always full of volatility, and no one can accurately predict the bottom. The best strategy is pyramid-style position building. Invest 30% of your capital at the current valuation level. If the stock price falls by another 10 to 15%, invest an additional 20%. If it falls further, continue to increase your position gradually. This strategy allows you to stay calm when the market is panicking, acquire more chips when valuations are lower, and ultimately average down your costs and increase the probability of returns. Warren and I did not buy BYD, Coca-Cola, or Apple in a single transaction. Instead, we built positions in batches over several years while continuously tracking the operating conditions of these enterprises. Investment is a marathon, not a 100-meter sprint. Discipline and patience are more important than precise market timing. For Chinese assets, what we need is a long-term perspective. Ignore short-term fluctuations, focus on the intrinsic value and long-term trends of enterprises, and time will ultimately stand on the side of value investors. I am 99 years old this year. In my investment career, I have experienced the Great Depression of 1929, the stagflation of the 1970s, the 2008 financial crisis, and witnessed countless market panics and frenzies. I have always believed in one truth: cycles never fail to arrive. They only arrive late. The market is like a spring. The harder it is pressed down, the stronger the rebound force will be. And today's Chinese market is like a spring that has been pressed to its limit, and the IMF report is just the hand that gently releases it. The 5 categories of assets we discussed today: high dividend core, SOS special valuation assets, globally monopolistic manufacturers of the new 3 exports, post-regulation era, tech internet giants, healthcare and insurance, under the silver economy, and leading domestic brands amid consumption upgrading are not isolated opportunities. They are a microcosm of China's economic structural transformation and the core targets of global capital repricing. They share a common characteristic, being seriously undervalued by the market, yet possessing extremely solid intrinsic value. Warren's and my investment philosophy has never changed. Be fearful when others are greedy, and greedy when others are fearful. Today, global investors are fearful of Chinese assets and are being swept up by the noise of geopolitics and short-term fluctuations. But this is precisely the most precious opportunity for value investors. When everyone is looking for certainty, certainty is often already reflected in the price. When everyone is avoiding risks, risks have already been overpriced, and the return of value is imminent. The resilience of China's economy exceeds many people's imagination, and the competitiveness of Chinese enterprises is rising on a global scale. The IMF report has sent a clear signal. China's economy is stabilizing and recovering. Structural transformation is accelerating, and policies are tilting toward shareholder returns, consumption stimulation, and green transition. These signals are paving the way for the valuation recovery of Chinese assets. Finally, I want to ask every investor here, are you willing to continue watching from the sidelines in fear, missing this unprecedented value repricing opportunity? Or are you willing to believe in the power of cycles, trust in the charm of value, be greedy when others are fearful, and seize this opportunity of wealth transfer? The essence of investment is insight into human nature and adherence to laws. The value depression of Chinese assets will not last forever, and the market pendulum will eventually return to balance. If you agree with the concept of value investing, if you believe in the long-term potential of China's economy, then now is the time to act. Remember, the best investment opportunities always arise when the market is at its most pessimistic. And today, we are in exactly such a moment. May you adhere to rationality, embrace value, and reap your own wealth and growth amid this wave of valuation recovery of Chinese assets. Thank you all.